Welcome to Investing for Generational Wealth. I'm Keshav Kalor, and I'm joined by my co-host, John Lai from Clive Capital, where we help high earners just like you invest outside the stock market to passively achieve long-term wealth generation through superior risk-adjusted returns, long-term passive income, which is the topic of today's webinar, and tax benefits. Together with investors, we're renovating over 900 apartments, actually over 1,000 apartments now. We're about to close on another 100. So over 1,000 apartments, build over 500 single family homes from the ground up. So there's an affordability problem in this country, and we're helping to solve it with the help of investors like you. Before we begin, a quick disclaimer: we're not financial advisors. My friend John, my friend Justin, and we just like to dress up and get on here and talk every Wednesday. That's it. All investments are subject to risks, including the possible loss of the money you invest. So perform your own due diligence before making any financial decisions. And of course, consult your CPA, your attorney, other professionals in your life before beginning investments. I'm your host, Keshav Kalor, and again, joined by my co-host, John Lai, and welcome to today's episode, 6 Steps to 6 Figures of Passive Income with Justin Moy. Today's guest, Justin, thank you for being here with us today.
Yeah, thanks so much, man. I've been following, the Clive Capital and what you guys are doing for the show. It's so cool to see what you guys are doing. I think a lot of people, they get into this space with the mission, and that mission typically is to make money for their investors and also help with the affordability crisis. That's a major thing that we all see. And along the way, I think sometimes those things get muddy, and other priorities may take over, but you guys have been so committed to the original mission from the start. And it's so cool to see people really stick to their true values and stick to what they know is really providing a ton of value, not just for their investors, but really for the country. So cool to be a small part of this big, massive machine that you guys are building and join you guys here today.
Appreciate the kind words, Justin. So let's get started for our audience and for us. I mean, this is our first time meeting each other. We'd love to hear about your background, how you got started, your life before even, passive income became a big part.
Yeah. So my life really has been real estate. When I was 17 years old, I was like most people who are kind of getting ready to become adults. I was looking for a career path. I was looking for meaning, and I was looking for a job. I wanted to test out an office job, and I found an internship at a commercial real estate office. That company was called Cassidy Turley. Since then, it's been bought and sold many times, and it doesn't exist anymore. I think the CBRE ended up buying it or something like that. But that was my very first exposure into the real estate games when I was 17. And I was helping commercial brokers with pitch decks, and I was helping them do market research, and I was seeing them close these big deals, and I was seeing them in and out of the office. And I immediately kind of caught this bug of like, this is such a cool environment. I was at a point in my life where I wanted to know, hey, how can I make good money? How can I have a good work-life balance? How can I find joy in what I do? And all the brokers in the office seemed to have that. So when I was 18 years old, I got my real estate license. This was in the Bay Area of California, in the East Bay, across the bridge. And interesting fact, I had a listing on $1 Million Listing San Francisco, if people like those shows. And I don't have the personality for TV, is what I was told. So I was stood in by an actor who played me, and kind of got the 5 minutes of fame that I wanted to get. So sold homes from a very young age, very successful there, very thankful to be successful. And ultimately was looking for, hey, I'm making great money now, but I knew 2 things. One is I knew that would come and go. It's feast and famine in a lot of these fields, real estate especially. So I was enjoying the feast, but I always thought, hey, the famine is coming. What do I do? And the second is I knew I didn't want to work forever. That's kind of taboo for some people to hear. Some people might feel like it's you're lazy or whatever. Like, I just don't feel that way. I just didn't want to work forever. I was 20 years old. I didn't want to work for 40 years. So I naturally was thinking, how can I capitalize on the feast that we're having now to set myself up in the future? Ultimately, I looked at real estate investments. Most of my clients were investors in the Bay Area of California. Very tough to make those investments work. So naturally, I started looking at estate. I figured if I'm going to go out of state, I want bigger deals so I can kind of get more scale. fell down the rabbit hole of commercial real estate and multifamily investing. And so, fast forward now, I'm going to be 31 in a month, next month. And I've been in the real estate game, this whole time in some capacity. And now managing funds for larger groups like you guys who are doing great things out there in the multifamily and commercial space. So that's the 10,000-foot view from 18 to 31, essentially.
So that's interesting. I got my real estate license as well. I wish I'd gotten it 18. I got it at 23. Am I doing my math right? 23. Yeah.
Yeah,
We'll
it's a good journey.
Yeah.
Yeah, it's a good journey. And I think it's an experience that was invaluable to me. And one thing that was interesting to me, because I realized that over the years of being in real estate full time, you acquire this knowledge that is very rare for people to get. I remember my friends asking me, hey, I'm getting ready to buy my first home. Like what's a title company? Like, what do they even do? And I'm like, oh my God. Yeah. So I just realized like, man, people just don't know this stuff. And even people who do buy houses, they typically do it a couple of times in their lifetime. But I was in it all the time. So I felt like, hey, I have this really cool knowledge of real estate that not a lot of people have. How can we use that? One thing that I'm a really big fan of is leveraging people's strengths, the who, not how method. And I figured, hey, my strength is here in the real estate game. Let me be that who, not how for people, and I can kind of elevate those people for their goals if they want to buy properties. So yeah, it's such a cool experience. I think you get to work with all the facets of real estate transactions when you're in the broker space. So it was definitely a great experience. I don't know if you share the same sentiment. Some people tend to have mixed feelings of being real estate brokers.
I was an agent I got licensed on Leap Day, actually, of 2020.
Okay.
And then COVID hit.
Yeah, there we
and
go.
then I sold a few homes, but luckily before I went too down that rabbit hole, that's when I learned about syndications later that year. So I just immediately switched to that. Not a typical route that most people take. I think most people stick in single family a lot longer, but I think I was just lucky enough to come across the concept so early on in my real estate journey.
Yeah, and I think that is such a common thing that I hear from our investors. Like, dude, I wish I knew about this sooner. Like, why didn't I hear about this stuff? And we could talk about why maybe people don't hear about a lot of these opportunities, but it's somewhat this guarded secret where previously, unless you were a hedge fund or a family office, or you were approached because you were a big time 7-figure earner or something like that, these were just not on the table. Like my parents, I still don't even know if they know exactly what I do. Like it's just so foreign to them. Like they just can't even grasp that. To so many people for generations, it's been conventional. It's been work your job, put your head down, climb that corporate ladder, do your employer match on your 401k. A Roth IRAs are great, post-tax money, and eventually you'll kind of cash it on this really big pot of cash. And I'm so glad now that with like social media, with some relaxed laws, we can talk about these things more often and just give people options. I truly do believe at the bottom of my heart and really with all of my soul that if everybody knew that there were certain options like these in real estate investing, I don't think there'd be a single person who wouldn't participate in some capacity. There's options for low barriers of entry. There's options for higher barriers of entry. It's just an education thing. That's why things like these are so powerful. Shows like yours are so powerful. Companies like yours are so powerful to just educate people and just let them know there's different things here that might fit your investing goals better than what everybody else has been doing for generations.
Yeah.
How did you? Oh, sorry. I was going to ask, how did you select your buy box of commercial real estate? It was a natural transition from residential over to commercial and multifamily.
Yeah, so it's interesting because multifamily to me was more. It was more. I was more able to grasp it. Maybe is a better way to say that. Yeah. I think a lot of people, they naturally go through this progression. Like I'll buy a couple single families, I'll do a fourplex, then I'll do bigger buildings, and they kind of grow. And everybody has probably lived in an apartment. Like we get it, we understand it, we understand there's demand there, we know who the customers are. So I'd be lying if I didn't say a big part of it was, hey, I always just felt more comfortable in that space. I understood it. I even leased some apartments when I was a real estate agent, so I got the economics of it. And really, as we progressed more into our careers in the commercial space, now we do other things, industrial space, there's warehousing, RV parks, where you start to get more comfortable in different assets. But really, I'd say it was comfortability. One thing to think about too, when a lot of people ask me, what's a good asset class for them? One thing I like to say is, in the 6 steps to 6 figures of passive income, one of those big steps is to multiply your equity. So you guys probably know this pretty well, but apartment buildings right now still have the highest multiples on equity that they trade at in terms of their cap rates. You can add $1 of net income to an apartment building, and in some markets that adds $20 of equity to your property. So there's not many assets that do that. And to give people, a benchmark, healthy businesses in very broad strokes tend to trade at about a 4x multiple of income. So to have 20 or more X is pretty powerful. So to me, that's why we've stuck in apartment buildings for the long haul. Their multiples are just so strong, but comfortability is a big part of that too.
Got it. It just dawned on me that, and so go ahead.
Oh no, I said I missed it, but where exactly did you make that jump between, like you started as a realtor at 18, where did you make that jump between being a realtor? What was your, how many single families did you buy? Did you go straight to, a fourplex or?
So I never bought a single family for myself. The very first investment we did was a 40-unit property. I brokered a lot of single family homes, and, cash wise, I didn't see what I wanted to see in the Bay Area, and I wasn't comfortable buying a single family home out of state. I don't think it's a bad thing to do that. It just wasn't really for me. So, you asked when did I make this switch? I'd say it was like years of looking and researching and reading and being like, that's cool. Oh, that'd be cool to do one day. Yeah, that makes sense. And going to conferences, and without really doing the things that you need to do, underwriting deals and networking with brokers and all that kind of stuff. And so, we've been in the commercial space now for about 6 years. So whatever that math ends up being. And that's when I really jumped in. But I've had this kind of this seed planted in my head for longer than that we were really doing a lot of research. So I don't know that there was a flip of a switch where I said, hey, I'm done doing sales. I'm just going to do apartments now. It was kind of the slow burn of research on my side.
I was going to say that I think, jumped the gun, and the title of this is 6 Steps to Passive Income.
Yeah.
So you talked about a few of them. Could you go over your 6 steps?
Yeah. So the dirty little secret to my 6 steps to 6 figures of passive income presentation, it's a presentation I've given to quite a few groups, it's a lie. It's actually 4 steps, but 4 steps to 6 figures doesn't sound that good. So I added in 2 more kind of bonus steps, but really there's 4 that if you're a high income earner and you want to replace your your 6-figure income with purely passive income, there's really 4 things you need to do. And we'll cover 2 more bonus ones. The first step I always tell people is you have to find your number. I call it their magic number. Some people call it their freedom number, whatever it is. Essentially what you need to do is determine, how much money do I need to have invested in ultra safe, ultra recession resilient, consistent payout assets to replace my income? To make $100,000 a year in passive income right now, in what I consider to be the most consistent and the most safe and the most even payout, is probably debt funds, larger debt funds. They're going to pay you anywhere from 9 to maybe 11% per year. They're going to pay you every single month. They're very diversified. They're resistant to recessions. That's probably where you're going to look when you're ready to live off of your passive cash flow. At a 9% return, you need to invest about $1.2 million into something like that. Now, most people don't have $1.2 million to put into some kind of fund. And if you do have that much cash, you kind of spread it out a long time, right? So the first step is to really find out what that number is. If you want 6 figures of passive income, 1.2 million, that's kind of the number in my head. The second step is you got to get that 1.2 million. And you do that by looking for ways to multiply your equity. We talked about apartment buildings and why we do that. They have the highest multiples right now. So you want to look for assets where you can get 18, 19, 20, 25% returns on your money. Now, it won't be in this slow burn cash flow, but over time, that's going to give you way bigger bang for your buck. So if you're starting out with 100 grand or 200 grand, or you need to work your way up to 1.2 million, look for ways to multiply your money. And that's actually where a lot of people get it wrong, is they start looking at cash flow, right? They look at like Brandon Turner buys for cash flow. Yeah, Brandon Turner has tens of millions of dollars. So that investor for cash flow is really significant. But if you do the math and you're buying homes, $150, $200 per month profit at a time, it's gonna be a long road for you to replace your significant income. So look for ways to multiply your equity. If you get those two mixed up and you start going cash flow first, and you kind of skip that equity piece, it will take you about 3 times as long to build up the pot of equity that you need to get to that 7-figure mark. So right in understanding those steps right there, you do 3x the time shaved off of your timeline. After you've built up that pot of equity, that third step, cash flow your investments. Look for the debt funds, look for the triple net leases, look for the ultra conservative, generally lower return, but much lower risk profile opportunities that you can put your cash into. That's going to help you cash flow into your 6 figures every single year, very consistently. And my fourth step is always keep your money from taxes. We as Americans are some of the most taxed citizens in the world. Now, it may not always come in the form of income tax or one kind of tax, but we're the most taxed citizens in the world, some of the highest ones. The average American pays between 30 and 35% of their income in taxes. The average high income earner pays between 40 and 50% in taxes. So understand that the ultra wealthy invest in real estate for appreciation and depreciation. Depreciation is the magic bullet. It's why you hear Donald Trump is this ultra billionaire and he pays no money in taxes. He's using these strategies. So if you can understand depreciation, you can expedite your time there as well. So those are really the big 4. Now I'll stop there before we get into the 2 bonus ones. I'm curious what your guys' thoughts are. Is that kind of a similar investing philosophy that you guys see or hear, or totally disagree, or what are your guys' thoughts? I'm curious.
I think that, well, I agree that people should be putting early on in their investment career, they should be putting appreciation over cash flow. Like you said, that's one of the big things that we say, because we're developers. We invest in built-to-rent developments, single family homes.
Yeah.
And so we always say that you build wealth and then cash flow off of that. You don't use cash flow to build wealth. You build wealth to create cash flow. So definitely.
I agree. And I think it's one of those big reasons why I look to commercial investing as well, because I have a good colleague of mine who is very, very big in the single family investing kind of coaching space. And I won't say who it is, but every single person in the real estate field knows who this guy is. And he was walking me through his system, and he's like, hey, if you can get 200, 250 bucks per month in a home, that's really good. And I was like, 200, 250 bucks. Like, I got to work 100 years to start getting some significant movement here in my life. So to me, if you miss that part and you're just chasing that couple $100, you're in my opinion, you're going to get there a lot faster. And it sounds like you guys' experience. Look for your growth, value add multifamily, new developments, build to rent. All these things give you much bigger growth opportunities. And now when you got cash flow off of a 7-figure portfolio, okay, now you've got to walk away from your job money. So definitely. And then there's 2 other ones that we talk about to make the 6 steps to 6 figures more even and easier to digest. 5, you got to prevent your losses. And there's another sub lesson within here. There's no such thing as stagnant money. Money is either always gaining or it's always losing. Over the past couple of years, we've really felt that burn, where inflation's been, 6 to 9% certain years. Now that's not normal. And a lot of investors will use that to kind of fear monger and push, but really at 2 to 3% inflation per year, that's a tax, that's a fee. Your money is losing if it's not working. So prevent losses. It's much more likely that you hit 4 singles than it is that you're going to hit a home run every single deal. So look for ways to pull back your risk tolerance and understand that stagnant money is losing money. Money does burn a hole in your pocket. Get your money working for you. And then the sixth step is to start out optimized for your lifestyle. I've had a lot of investments that I've walked away from that would have been phenomenal investments, but they impacted my lifestyle. I was telling, John, we were talking before this, I'm in Costa Rica right now. I'll be here for about another month. I could not manage some of those investments from anywhere in the world, which is a big thing for me. I love to travel. I love to go out and do different things. Look for assets that are not going to pull on your time. And if you like to travel, understand that. Don't buy things that don't let you travel. Really understanding that when you are buying assets and investing in different assets, if every time you invest, there's a call on your time for that asset, you're going to have a very short road of scale. You're going to hit a wall pretty quick. So start with that end in mind, optimize for the lifestyle that you want in the future, because the last thing you want is financial freedom without the freedom part, and you just got all this cash. So those are the 6 steps. Those are what I talk about all the time to our investors, and that's really the playbook for building a work optional lifestyle in what my opinion is the fastest and most risk-adjusted way.
You talked about 9%, 8-9% debt fund. Where do you go for that? Because you can't go to your bank and ask for a debt fund like that.
Yeah. Oh, well, shameless plug. You can come to us. We have a debt fund. It pays out anywhere from 8 to 11%. Hasn't missed a distribution since inception in 2014. Hasn't underperformed a month since inception either. When you look at debt funds, essentially what it is you're the bank, right? So you can't go to the bank because the bank takes your money, pays you 0.5%, then they go do this kind of stuff like this. So your return comes from interest payments of usually like lenders or developers or flippers who have these shorter term loans. So you're going to look for debt funds, or some people call them hard money funds. There's different kinds and there's different nuances to them. Now, the reason I said, 8 to 10%, 11% is those are your safer debt funds. Those are your first position liens. Those are your low leverage loans. You can look up debt funds. I've seen debt funds with as high as a 15, 16% preferred return. Those are mezzanine loans. Those are lower in the capital stack. They're higher risk, therefore they're higher return potential. But those are the types of products where if you lose your whole shirt. So you have to balance those things out. You can really crank up and down your returns based on your risk tolerance. So yeah, you can't go to a bank and get that. There's no CD that does that. There's no, brokerage that's going to have that for you. You got to go to hard money funds, which have a lot of diversification across a lot of asset classes and have a lot of loans.
All right, thanks.
One thing you mentioned was about reducing risk and mitigating that in step 5, I believe, and then also not letting your money burn a hole. What do you look for in your investments to make sure that you're hitting singles and you're not getting out?
Yeah. So one thing that I like to do is, well, now we're pretty blessed. We're spoiled. We have these high yield savings accounts, these CDs that could be 3, 6, 9 months that are pretty liquid, that are still going to pay you 5%, high 4s, low 5%, which will kind of help you keep pace. Inflation this year, we're looking at about 3%. So, hey, if you got an asset, if you got something that did you 5%, you made 2%. So you're not losing, but you're kind of taking a safer position. So right now, I'm still in big growth mode for my personal investments. We're still doing value add properties. I actually use our debt fund for my more liquid investments. So that's where I kind of park cash, because usually there's about a 90-day redemption window there. Historically is redeemed in about 14 days. So we have investors that park cash and stuff like that while they wait for deals, or if they know they'll need cash in another year or so. But really the way that I do it and the way that I keep my money moving is I'm in this every day. I'm in this every single day, looking at deals, looking at trends, seeing what assets we want to invest in. And there's no shortage of deals right now, but there is a shortage of great deals right now. So if you're in the game all the time, you're going to have a lot of opportunities. And then if you're associated with companies like yours or a company like ours, you got to kind of skip the line and you got to come into the deal when it's got a bow on it, it's ready to go, and it's just ready for cash. But yeah, I stay very, very active in the space. I do look at liquid investments. I have my high yield savings accounts. I have my short-term CDs. I have my debt funds, but most of my money is going to go into those growth buckets we're building equity right now.
For everyone who has questions, the attendees, please put them into the Q&A window and we'll answer them as they come up. Where do you source your deals, Justin? Just out of curiosity. You're in Costa Rica, so you're not out and about shaking hands.
Yeah, not anymore. So my career in being in the commercial real estate space, for 2 full years, all I did was acquisitions. I networked with the brokers. I underwrote deals. I've underwritten thousands and thousands of deals. For me, it's mind numbing. I don't like that stuff. I'm not built for it. So I think being very analytical was a muscle that I wanted to build, which is why I did it. I did that with my partners. After about 2 years of doing that, I spent 2 years managing assets full time, managing the acquisitions that we bought in those first 2 years. And then over the past 3 years, I've been doing full-time fund management. So essentially what I do now is, groups potentially like yours will come to us and say, hey, Justin, we have this awesome build to rent community. This is the project. This is the business plan. We're raising $10 million, $20 million. Are your investors interested in this? We do our due diligence. Through that due diligence, we tend to get about 30 to 60 deals per month. We tend to do about 2 to 4 deals per year. So I'm not so much doing a lot of the hardcore underwriting anymore, but I look at different due diligence. I will re-underwrite deals. And we're fortunate that we get deal flow sent to us at this point. But it's a grind. When you're starting out, you're making phone calls, you're knocking doors, you're showing up to brokers' offices, you're dropping in on sellers, you're networking. It's a grind. So it takes a while now, but we're fortunate that we have good deal flow now. And I'm more just checking things as opposed to starting from scratch.
How about for passive investors, folks who don't want to talk to brokers and put the deal together, but rather just invest into a fund like mine or yours? Like, how would you recommend they go about it?
Yeah. So yes, your investments are totally passive. Where your work is upfront. So it's meeting the Johns and the Kashabs. It's meeting the Justins. It's making sure that our values align with you as an investor. It's making sure that our risk profile and our return profiles align with you as an investor. A great example is you guys do a lot of development and build to rent. We don't. I don't have the risk tolerance for it. I like to see cash flow coming in. I like to have a thing, so you guys just have that better vision that I do. I'm also not creative like that. Like I can't look at a plot of dirt and envision what's going to be there. You guys are much more creative than I am in that sense. So, that's a good example of, hey, maybe you're a good fit for Clive, but probably wouldn't be a good fit for our company, President's Club investors, if you want to like new developments. So if you're a passive investor, I think that's the first step. You got to figure out like who are the people that meet my criteria from a returns, risk, and a values perspective. You got to set up those calls. We talked earlier on the show about access to types of deals like this. One key point of access is you got to have a substantial relationship with your investors, right? So set up these calls, meet the Johns, the Kashavs, the Justins out there, learn why we buy the deals we buy, listen to the podcasts, get on our newsletters, learn about why we're passing on deals, why we're bringing deals out to market. And then eventually when you see a deal, be educated enough to hit the button and go, because great deals and great fund managers fill up deals quickly. We tend to fill up our deals within about 3 weeks, 2 to 3 weeks. So you want to front load your learning, because when you see something you like, typically you have to act a little bit quicker. So if you're a passive investor, that's where your work is. That's where your relationship building is. You're not meeting with brokers, but you're going to meet with fund managers. You're going to meet with the Clive Capitals of the world. But there's ways that you can narrow down that list so you're not shaking a bunch of hands. And then when you meet the few people you like, you kind of start expanding from there. But that's the first step to get started.
How have you, I'm thinking you're six years in, how have you optimized your business? Setting yourself kind of optimized, looking back at maybe day one of when you started, like what did you do differently? And then what has technology done that has maybe made your life a little bit easier?
Yeah. So, the deals that we did my first year in the business are not deals we would do now. And we didn't bring on any investors that first year or those first few deals. The deals did just fine, but looking back, their risk and return profiles were just not what we would look for. They were a little bit higher on the risk scale. They were, C to C minus area properties, but we were just so hungry for deals that we were looking in places that other people weren't looking. And we quickly found out why not many people might look in those areas. So, you learn a lot through those processes. And I actually think it's really important that people, if they manage funds or if they're, in my position where they're outsourced fund management, that they've had experience managing deals, underwriting deals, going through the entire funnel of acquisitions, because that helps me look at deals in a different way. A really quick example is now when we look at deals, something that I haven't really heard a lot of people will do is we call the police department that's local there. We call the fire department and we say, hey, we're moving in the area. What do you think of this apartment? The best answer they can give me is, I've never heard of it. But if they know the apartment, they know the complex, they're like, yeah, you kind of pick up on these things really quickly that an investor deck will never show you. An investor deck will never show you that the police are there every other weekend, that there's, the tenants don't have jobs there. If you go there in the middle of the day, the parking lot's full, everybody's home still. So there's a lot of things like that you cannot get from an investment deck. And I don't think you really get that experience unless you've been there, done that, and managed the deals. So one big thing I'd say is we don't do those types of assets anymore. We've kind of upped our game into the, maybe a C plus 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 property with great potential, but really we're kind of in that B asset now. We're okay not doing that many deals. We're fortunate that our portfolio is in a position where I'm okay if we do one deal a year. We could do no deals a year. We could do 5 deals a year. It doesn't really matter to me, but we're able to hold this standard where we're not super hungry for acquisitions that we need to, we got to pay our bills. So we got to buy a thing. Like, what's the next thing? So to me, it's evolved to us being ultra picky. And that's been the biggest help for us. Now, you mentioned technology. Man, I'm not going to give you some AI answer. That's like what everybody's talking about right now. I don't think there's AI tools that I trust to underwrite deals or that I trust to rank deals. There's a couple that are in development. Maybe one day those will be very relevant, but we haven't really used a lot of them. We have our underwriting model. Investor portals have gotten nicer for our investors, but that's really it. I'm not very leveraged on technology. I don't outsource my stuff to AI at this point. It's just not there. So, I'm fairly old school in that sense, but I feel like you asked that because you guys have seen some new exciting technology, maybe that you could tell me about. You guys are more in the tech space.
I would say that I've primarily used Gen AI probably for the content, right? Whether it's like visual content or actually written content, that's primarily it.
Yeah.
And I agree, like underwriting, it would be great to be able to get to that point, but it's not quite there yet.
They have a few tools that I've seen, and I've seen demos and people have given presentations to our groups, stuff like that. It's just that, yeah, like you said, it's just not there yet. But yeah, for content for sure, Opus Clip is a great one for like videos and stuff like that. So yeah, those things are really helpful for the marketing side of it. One thing I love to do is just go to ChatGPT and say, hey, pick out any words that are maybe too real estate-y and kind of pull those down a little bit. Most of our investors don't own any real estate besides our investments. So technology has helped us really relate and get our message across to people that, like I said, I've been in real estate since I was 17. Sometimes it's hard for me to understand that not many people are following what I'm saying. So it's helped with stuff like that. So yeah, I definitely agree.
Could you share, going back to like the 6 steps to 6 figures, share like success stories that you've seen of investors like through your funds, or maybe other investors that you've seen passively, ideally, who have established 6 figures of income from their investments?
Yeah. It's most of the time when we work the numbers for our investors, the magic year tends to be like 7. Where if they stick with a value add strategy through about 7 years, now, of course, given normal market, 5-year turns on the properties, all those types of things, that tends to be where most people start to see the cells in the Excel model turn green, and they can now kind of pull that back. A lot of people these last couple of years, they were hitting slam dunk home runs, right? We had people putting up 70, 80 IRR deals, or those were really the big hot times. So a lot of investors made a ton of money these past few years. Now those times are over, and that's not normal. And we're kind of seeing that take form now in like lost deals and lost capital, where people got over leveraged and now they're kind of feeling that downfall. So overall, I'd say yes, for most of our investors, at about that 7-year mark is when they see that they can pull it back. We've had a handful of investors who are at that point. This year, we've actually celebrated our most recent one. I gave him a call just to kind of check in, and he's in about 2 deals of ours, 2 deals from 2 of our most recent deals. And he said, man, it's really cool. I just kind of did the math. I'm still going to keep working, but I don't need to. Like I'm good. We do our, he does his net worth and his passive income tracking, every, I think, quarter or something like that. He's like, this is it, and so he was very, very adamant about investing. He was very frugal. He was in the fire community, right? Where he was really, really chasing that goal hard. For him, it came in about 11 years because he had a little bit of growth in his career. He was doing some stocks, some day trading, all that stuff. But real estate has been the most risk-adjusted way to do it faster for all of the investors that we work with. So yeah, it's very possible. I think if you really sit down and understand how you can multiply money and how, if you dollar cost average your investments and you just keep doing it, you keep investing, you start to see magic happen a lot quicker than you would think.
When you say 6 figures in passive income, are you saying for a value add deal, for example, are you counting both the appreciation and the cash flow? Like, let's say you sold in year 5 and you got invested 100 grand, you got 50 back on the sale. Are you counting that 50 in the passive income?
So I'm counting hitting, over a 1 million, typically about a 1.2 to 1.5 million dollar pot of equity, that now if you put it into a debt fund, you'll make $100,000 a year. You'll get paid every single month. So it's, when does your net worth, when does your available equity to you exist in a large enough quantity that you can now push it into something that's cash flowing, like a debt fund, triple net lease, or whatever it's going to be, and create that 6-figure of consistent cash flow. I don't consider it with the flips because most of the time when people are looking at their passive cash flow, they're looking to live off of it. So if you're banking on me selling this year and interest rates triple, now I'm not going to sell it, you can't be screwed, right? So I'm looking for more like, what are those consistent things? So it's after your value adds are done and you're ready to, lay off the gas, put it into those debt funds and sail off into the distance, go to Costa Rica, hit the beach.
This investor who, just to give folks at home an idea, like when they said that they're good after 7 years, how much were they investing every year?
It grows, right? So, they first had about 25,000 to work with, and then, the next year, and then with these things too come career progression. So this particular investor is in the military. I have background in the military as well. I sold real estate also while I was in the military. And so the way that military ranks and pay work is you kind of hit this pretty good trajectory. So when you start out, you have a little bit of money to work with, and then as you grow in your career, you get a lot more, you get a lot more responsibility, you get a lot more cash, you get a lot more benefits. And that is when, if you don't let your lifestyle creep come up on you, you get to really hit a lot of leverage. Because there's some promotions where now you might be making $15,000 to $20,000 more per year. And if your expenses stay the same, that's all upside. That's 100% to the bottom line. That's 100% into the investing pot. So he himself was very frugal. They didn't upgrade their lifestyle until they needed to with kids and things like that. But they were aware of their goals and they knew, hey, when I hit these promotions, when I hit these steps, when I get these bonuses, it's going to buy my future. It's going to buy my time for tomorrow. And so he had that front and center. He would revisit his portfolio. He was very serious about it. And he finally hit that point where he grew. And now, at this point, he invests, his investments are into the 6 figures with us because he has that ability now. So very natural to start off small, 10, 15, 25,000. And the next thing you know, you're sending out 6-figure checks because you're familiar with the game. You've built a lot of trust with people and you have that ability. So it's this runway. So if people are in the beginning stages, they may not be able to fathom that kind of growth, but really if you stick to it, you let time be on your side, you'll hit those really big strides.
Are your investments, you talked about tax strategies, and just wondering if your investments are structured in a way to like maximize those, taxable or minimize the
Yeah.
taxable events?
Yeah. So, of course, just like the disclaimer you guys put in the beginning, I don't think either of us hold licenses to really talk about these things. But
Right.
yes, a big part of our fund is we do pass down tax benefits. That's not something every single fund does. So we do pass down those tax benefits. So when you start to invest in a lot of deals and you are looking for a lot of depreciation, there are assets that are more tax optimized than others. Oil and gas is a good example where you can depreciate up to 100% of your investment as of, right now when we're recording these things. So, I wouldn't say that our deals are fully on the, hey, we're looking for tax benefits section, because there are other assets that do that. There are people that invest really solely for that. They're just looking to keep money. They don't really care as much what the upside is. They're just like, hey, I need some write-offs. The year is almost at a close. I need to spend some money out. So I wouldn't say that our investments are all the way on that side, but yeah, we do use bonus depreciation. We do pass down those benefits to our investors. I think that's super, super important.
Do you employ any advanced tax strategies like DSTs or any of those?
Yeah,
or even
we
like
haven't.
1031s.
Yeah,
yeah, go ahead.
we haven't done like the DSTs or created an asset class share for 1031s, primarily for the lift and the check size, right? A lot of times, if people are going to take 1031s in a syndication or in some type of fund, you're probably looking at least $500,000 as a check amount for that. I'm even hearing more people say, hey, $1 million, otherwise we're not really going to deal with it. There's a lot of fees that you incur for it. It's a lot of lift, separate set of legal docs. So it's fairly labor intensive. Now for me, I actually somewhat caution our investors, even if they approach us with $500,000 or more, and we've been approached by up to $1 million. Do you want all of that money right here in this what we're doing? I think diversification is a very big part of it, especially when you have that check size. I like this saying a lot. It's concentration makes you rich, diversification keeps you rich. When you have that check size, those 7-figure investments that you're looking to make, you're probably looking more for diversification. In my opinion, there's just other things that might be better suited for them. So we don't really do a lot of those things. We keep it pretty simple. Depreciation task down, and then we don't do DSTs. We haven't done those bigger check sizes or those asset classes for 1031s, but they are very effective strategies.
For people who are wherever they are in this journey, just starting out somewhere in the middle, what are some challenges that you would want to warn them of? And then what are things they could do to get past those challenges and just stay on track in general to 6 figures in passing?
Yeah. Man, it's hard to pick just one. I think my biggest lesson for a lot of investors is I talk a lot about due diligence. So I have a podcast. It's called Passive Real Estate Strategies. We always talk about investing as a limited partner. And front and center for a lot of people is how to do due diligence on a deal as a passive investor, as an engineer, as a sales professional, as somebody who does not, you put a marketing deck in front of them. Yeah, what does this mean? I would get very, very, very familiar with debt structures. Debt is the biggest risk on a deal. They call it leverage because it amplifies things. A lot of debt, a lot of leverage makes a good deal great, and it makes a bad deal horrible. If you lose your shirt on a deal, it'll be because of the debt. So people now are figuring out, what is this rate cap exactly? And why can't we get a new one? What is variable rate? What is 2 + 1 + 1? What does that mean? How come this one just says 2 and there's no +1 + 1? So there's a lot of things like that that you need to be familiar with. The very, very, very first thing, if I was a passive investor, I'm looking at a deal, I'm going to shoot straight to the debt part of the deal. I need to know, what are the terms? What's the rate? What are the things that need to happen in the markets, right? Because that's one thing that you don't control within the debt markets, to make this deal go sideways. And how is this debt and how much debt's on the deal? Most people would consider 75% or less debt to be safe on a deal. Anything above 75%, we're probably not going to do. Anything 80% or up, like, never touch it. again, it's just going to amplify the deal. If the deal goes well, you're going to kill it. But if anything goes wrong, it's going to derail the whole thing. So understand debt. It doesn't sound very sexy, and you don't need to understand capital markets that much. You don't need to really be like this debt genius, but you have to understand the terms, how much is being used, and what's your flexibility. What can you extend it? How do you extend it? Because a lot of people right now, they're saying extend and pretend or survive till 25. There's a lot of people with no extension options, and they can't do that. So those are the people that are hurting the most. So understand debt. That's the big one. Another big one is start thinking of deals. Only look at deals where a lot has to go wrong for the deal to go wrong, and away from deals where a lot has to go right for the deal to go right. You're going to look at things like cash flow, like amount of loan, amount of leverage on the deal, operations in that area, A, B, or C class areas. So just think of these things. Always look at it, when we're looking at deals, I'm looking at the downside story of it. What could go wrong to derail this entire thing? And that's where I start. And I actually have an interesting story that I think passive investors would find it interesting too. I have a colleague who invested in a deal. It was student housing apartment complex. And for whatever reason, the city decided to shut down the bridge that connected the campus to the apartment building. So it turned a 3-minute student commute to like a 25-minute, they had to go around the city or around, a body of water or something like that. That's what I call a single point of failure. Like a bridge, one employer, one industry in this area. Those are all single points of failure. Look out for those. Even if they're not likely, people like to say, oh, they're all government jobs. The government doesn't shut down. They could, or they could move. So, if you underwrote that deal banking on the bonuses that you get for student housing, that deal's ruined now, and you're going to lose your shirt. So, a couple of lessons that just kind of pop into my mind as they come up. But if I'm a passive investor, I'm just starting out, those are the biggest things that I'm looking for.
Outside of investing, just like general lifestyle advice, like as you're building passive income, I know one of the big things that you said is don't let lifestyle creep hit you. Are there other things where you would recommend, like, great, your investments are making money. How do you make sure that you're on that trajectory?
Yeah, I think one of the biggest things is when you make investments, understand if it's going to have a pull on your time. If I have to give an hour a week to every investment that I make, I only have so many hours that I can give. That's why personally I like the passive stuff. A lot of people, they go on Instagram and they see buy passive flips and they do this, a manager does all the work. That's not the case. You always have to manage those things. So understand that there's a difference between buying real estate and investing in real estate. Buying real estate will never be passive. You're buying a job. Now you're not buying a 40-hour-a-week job, or at least hopefully you're not, but you're still buying a job and you're buying a responsibility. Investing in real estate, you're not. You're an investor. So understand that where you're at right now may not be where you want to be in 10 years. And these are illiquid investments. So if you're investing for the now, you might hinder what you want in the tomorrow. So lifestyle creep is a good one to keep in check as you grow, but understand that when you're making investments, don't invest in things that have a pull on your time if in the future you're not willing to give that time. That's the biggest thing that I see a lot of people is a lot of people come to us and they say, hey, I have a single family portfolio. I just can't do it anymore. I just don't want to do this. Now I'm looking for stuff like what you do. So invest now with that in mind, with your future in mind. I think that's the biggest one for me.
Yeah, a lot of people underestimate. I mean, we're talking to people all the time, right? And they're like, oh, I'm doing this much on my flips, or I'm doing this much on a ADU that I'm putting on, where it's like, okay, you might be doing 25% a year, 30% a year, but what kind of tax benefits are you getting on there? And then how much work are you putting in, right? Like you might be doing 30% a year, but if that requires an extra 10 hours of work of your time every week, is that really better than a 20% return per year, but 0 extra hours of work?
Yeah. And I think a big one for that too is at some point it's return on headache. You can make more money if you do a bunch of other stuff. If you buy certain businesses, if you flip houses, if you build yourself, at some point your return on headache has to be in check. So understand what helps you sleep at night and what helps you live really the best life that you want to live. For most people, it's not managing a massive single family portfolio over 15 states or whatever it is. Those things can tend to cause headaches. So return on headache, that's a good metric to look at too.
Cool. Well, we have 5 minutes left here, so let's end with some of the questions that we like to ask everyone that's on our show. So first one, describe some of the failures that you had and what you learned from it.
Yeah. So, I had an investment. I lost $60,000 on the investment. It was, in my opinion, the best investment I've ever made. It's made me so much more money after that, just understanding the lessons of neighborhoods, of government vouchers, of how, a slam dunk home run deal can go sideways. Now we didn't have any investors in that deal, and it's me that took the loss, but that was, it's tough to call it a failure because although it was a financial failure, it's only a failure if you let it be a failure, and it's only a failure if you don't learn and reflect from it. So that deal itself added pages to our due diligence checklist, and it serves our investors. So I see it as a $60,000 investment in my knowledge and a $60,000 investment in our due diligence process that's made that rock solid to date. So, it's a failure if you let it be a failure, but at the time it was definitely a massive failure. So it was a tough check to write off, but I think that was a really big one. But again, the lessons we learned from it were worth well beyond $60,000.
Was it a Section 8 deal? Like what kind of deal was it?
Yeah, it was a voucher apartment. It was an apartment that we were going to buy and then put on voucher housing because vouchers in that area paid more than market. And so, we thought, man, more than market, guaranteed rents, what can go wrong? We had a property manager that worked with that type of tenant base all the time, very confident, but you find that in certain cities, it's very, very, very hard to work with them. It's very, very, very hard to get licenses and inspections, and the goalpost changes on you all the time. And that inspector who told you got to do $5,000 worth of work on here, the next inspector comes out and says, well, those were the wrong codes. You got to use these ones. This required, but and you're just so at the whim of these people. So yeah, it was the deal I was probably most excited about because I felt like it was the most sure thing. Ended up not being so much. So, get out of it and just live to fight another day.
How do you give back to your community?
Yeah, so I'm very passionate about a few causes. One is dogs. I have a small dog and I love her to death. And the other is hunger, specifically with children. So I think hunger is such a ridiculous problem for us to have in this country. It's really not a resource problem. It's kind of an effort problem. And so to me, anytime that I can give back from a hunger perspective, whether it's giving food or packing food or buying different stuff at the store and putting those donation bins, whatever we could do, I think that is super powerful. I came from a family where, people skip meals at certain times of the day. And so to me, if I can help other people prevent that type of lifestyle, especially when they're kids and they don't really have control over their situation, that's something that I'm very passionate about. Yeah, so those two things really take up a lot of my monetary giving back and my mental capacity too, and my personal giving back.
That's good to hear. Kids and dogs, who could say no?
I know, yeah, exactly. Especially when it's something like food, of course, yeah, there's food right there. It's easy to do. It's easy to get back. It's directly impactful. So I think it's really powerful.
And for those who are interested in learning more about you, reaching out to you, connecting, what are the best ways to do so?
Yeah, I'm most active on LinkedIn. Look me up, Justin Moy. My monocle is the President's Club Investor. Our company is called President's Club Investors. That's because about 60-70% of our investors are in the sales space, but we work with people in all over the space, military, engineers. I'm most active there. I post every single day. If you add me on there, we can message, we can talk, set up calls, whatever's best for you, but that's going to be the easiest way to get a hold of me. So Justin Moy, the President's Club Investor.
Great. Well, Justin, thank you for joining us today and teaching us about building six steps to building 6 figures in passive income.
Yeah, thanks so much for having me. This is great.
Yeah. Thanks, Justin.
All right. Well, for those of you listening at home, like and subscribe to whatever platform you're listening on, and so that we can continue to bring you this educational, valuable content. And until next week, keep learning to invest for generational wealth.